The CNBC app. Global market news in one place. Customizable sections and personalized alerts. Stocks tracking, interactive charts and market insights all in your hands. Stay connected. Stay informed. Download the CNBC app today.
A very warm welcome to Squawk Box Europe with Karen Cho, Juliana Tattelbaum and myself, Steve Sedgwick, and these are your headlines. NATO leaders agreeing to ramp up defence spending to 5% of GDP, with Europe breathing a sigh of relief as US President Donald Trump renews his commitment to the military alliance.
It's a monumental win for the United States because we were carrying much more than our fair share. It was quite unfair, actually. But this is a big win for Europe and for actually Western civilization.
Attention in Brussels now turns to the European Council summit, with the bloc's leaders set to discuss how to align defence efforts around ongoing support for Ukraine and a volatile situation in the Middle East.
And Shell putting out a clarification statement, which is very important because for stock exchange purposes this is very important as well. Shell has recently issued a statement in response to media speculation about BP, has clarified it has not been actively considering an offer for BP and confirms that no discussions have taken place with BP about a possible acquisition. This is important because this is a stock exchange announcement. Right, a lot of speculation about Shell. Extraordinary Wall Street Journal. I have a lot of time for the Wall Street. Good morning, by the way. Nice to see you both. I have a lot of time for the Wall Street Journal. I know a lot of their energy analysts, commentators, reporters. They have great sources within the oil industry as well. So very interesting that they appear to have got this story wrong, or certainly they've had information which is not the full story. I think that's fair to say. The denials have been forthcoming. The reason why I think this stock exchange announcement is very important, because they're making this announcement, and I took over your headline because I saw it and I thought it's quite important to get our viewers up to speed on this one as quickly as possible, because this is made under Rule 2.8 of this UK City Code on takeovers and mergers. Why is that important? Because this is a clear clarification that they are not bidding as well, which I think, and unless I'm missing something on the rules, means that they can't make a bid for 6 months if they said they're not in talks. Now, the problem is, if others are now bidding for BP, or certainly circling, having a look at it, running the slide rule, we've talked a lot about Exxon previously, we've talked a lot about ADNOC previously as well. The fact of the matter is that would obviously make it very difficult to Shell to jump into the fray. Maybe there's some material change clause or something where actually they can jump in as well. But very interesting. Shell noted that under certain conditions, such an agreement with BP's board or a material change in circumstances, there's the caveat, a material change in circumstances, it might reconsider its position. It's a short statement. I think it's a very important statement.
The language from the Wall Street Journal article suggested that company representatives are in talks, that those talks were active, but we don't know what type of company representatives. Perhaps it was not at board level. It might have been much lower down in some sort of M&A team, discussions about what it would look like if it were to happen. So those conversations might have been real, might have been live, but now pushback in the statement suggests it's not going to be progressing from here.
Can I be a dullard? And I wouldn't normally do this, but I'm going to the City Code on takeovers and mergers and looking at Rule 2.8. And I think it's really important. Sometimes you have to go to this boring stuff in order to be able to know whether you want to buy or sell this stuff. Rule 2.8, specifically a person who announces that they do not intend to make a takeover offer for the company, Rule 2.8 statement, is generally prohibited from making an offer or acquiring a significant stake in the offeree company for 6 months. There are exemptions. Here we go. This is my point, such as if the potential offerer has specified in the statement that it can be set aside under certain conditions. Back to Shell's statement on the stock exchange this morning, under certain conditions. See, this is brilliant. We're doing this for you as we think. Such conditions, an agreement with BP's board or a material change in circumstances might reconsider its business. I reckon an ADNOC or an Exxon bid for BP would be a material change in circumstances. Ladies and gentlemen, I think we've done it for you in 5 minutes.
I think that the point about ADNOC or another bidder potentially coming in here is critical, because if you've got Shell now forced to acknowledge that they haven't approached BP yet, what does that mean for the competitive tension here if Shell has acknowledged they haven't approached them yet? But to your point, things could change, and this story is one to continue watching, because it's not just Shell in the mix here. We are talking ADNOC potentially as well.
To me, the motivation was fascinating, because it suggested that if you didn't get consolidation between Shell and BP making a line on this side of the world, it would make it very difficult if there's a consolidation attempt by some of the American giants that we know have become much more valuable in recent years. So having the size and scale seems to be an important motivation for the industry. So what comes next? Who is the next mover and puts a foot out there in terms of M&A activity? I think it's going to be crucial.
Yeah, I think it's brilliant. The one thing I will say, just very quickly, everyone's saying what a basket case BP is as well. I disagree. There you go. I'm just going to stick that out there as well. And by the way, I hate to say it, but it trades at a greater PE than Shell does. All right, let's move on. NATO leaders have agreed to more than double their defence spending target to 5% of GDP by 2035, which will be made up of at least 3.5% on pure expenditure, with the remainder going on related infrastructure. This more than doubles the 2014 2% goal, which some allies, including Spain and Portugal, are yet to meet. Members will be required to submit yearly plans showing a credible incremental path to reaching 5% goal. Now, ahead of the meeting, Spain objected to the raised target. The Prime Minister Pedro Sanchez said Madrid would meet the alliance's new capabilities target, but said the 2% level is sufficient, realistic and compatible with the welfare state. The alliance also reiterated its ironclad commitment to collective defence. That's Article 5, as you well know by now, following questions about America's involvement. Speaking after the summit, US President Donald Trump hailed the agreement as a win for both America and Europe.
In a very historic milestone this week, the NATO allies committed to dramatically increase their defense spending to that 5% of GDP, something that no one really thought possible. And they said, "You did it, sir, you did it." Well, I don't know if I did it, but I think I did. This will be known as the Hague Defense Commitment, which is pretty good, pretty appropriate. When the allies reach this number, it will add more than $1 trillion a year. Think of that, $1 trillion per year to our common defense. And this is a monument really to victory, but it's a monumental win for the United States, because we were carrying much more than our fair share. It was quite unfair, actually. But this is a big win for Europe and for actually Western civilization.
So I spoke to Alex Stubb. He's one of the men, by the way, who's been accused of kowtowing to the president, playing golf with him, and he was asked about that during the presser as well. But the fact of the matter is, it's called diplomacy, and for those critics who don't get it, well, shame on you, because that's how it works in the real world. Anyway, I asked the president of Finland, Alex Stubb, for his take on the meeting.
It was actually a very good meeting. Cool, calm and collected. There was a lot of self-congratulation, which I think was deserved, because in many ways this was a historic meeting. It was NATO going back to its roots of collective defense as a deterrent to Russia. It was really about increasing defense expenditure to the levels that we were during the Cold War, so we're talking 5%. And on top of that, it was sort of a rebalancing of a new NATO, where you have more balance and more Europe in it. And I think President Trump was very happy, the Secretary General was very happy. There were those smiles around the table, regardless of the difficult situation that we're in.
I'll talk to you a little bit about that, because look, you have been part of an amazing diplomatic effort. I think you, the Secretary General, Mr. Rutte, I think Keir Starmer and others have really worked very hard on working out what the problems could be with the United States and sorting them out beforehand as well. It was a huge diplomatic effort. It looked from the outside as well. A lot of preparation went into it. Do you think the Americans are happy now that Europe is pulling its weight?
Yeah, I think the Americans are happy. And, I think there are two reasons why Europeans have woken up and smelt the coffee. One is sort of pressure, sometimes gentle, sometimes a little bit tougher, coming from the United States on increasing our defense expenditure. But the other one is self-interest. Finland has 1,340 kilometers of border with Russia. It's in our self-interest that NATO hikes up its defense expenditure. As far as my role is concerned, I see Finland more to be a small country in the back office, whereas it's the big guys, Mark Rutte, Macron, Starmer and Merz, who do a a lot of the work. But we work together as a team and as an ally, as an alliance, and I think it worked out this time around.
Well, I'll give you my very brief take on this one as well. I've spent a lot of time at NATO meetings over the years, and the concerns in Vilnius, the concerns in DC, the concerns in Brussels previously as well. I think this is unambiguously, as the President says, a massive win for both. I have been, I think, one of the biggest critics of failed European military spending strategy. I was lambasting Merkel for pretty much a decade as well, for the pathetic German spending on defence as well. There is no doubt about it. This is a brilliant outcome for Europe. It could have brilliant ramifications for trade deals as well, now that he has a rapprochement with the European leaders. It is great for European defence that we're finally taking it seriously as well. It's great for the United States because it means that they can focus on other areas as well. I think it is a real win for liberal democracy, and it's a real kind of, how can I put it politely? It's a real rebuff to those authoritarian nations out there who think that actually European defence and the liberal democracies are toast and on a historic decline as well. It's going to be tough getting there, don't get me wrong. I'm not looking at this as rose-tinted glasses about, oh, we're going to get 5%, we're all safe kind of thing. We're a long way off. But it is the foundations of such a strong basis for NATO. Actually, I think it's a massive win.
It was everything the market really wanted to hear, right? We've had money that has gone in very aggressively to defence portfolios, and the fact you've got this ironclad commitment to getting to 5% for a lot of member nations of NATO, the exceptions of course being Spain, so everything to justify the amount of compound money coming into the sector. From the other aspect, I mean, going into the NATO summit, we're talking about whether Article 5 could be redefined. The whole founding principle of NATO, an attack on one nation is an attack on us all. So the fact that we had a very strong guarantee around that, we're all in, we're all together, the statement from Trump, I think that was very positive for calming some of the risk of sentiment that might have been forthcoming if that had been truly tested. So tick for the markets. But what comes next? And this is a market that doesn't just look at the immediate ramifications of one meeting, one summit. It looks at the medium long-term consequences. Can some of these nations remain committed to the 5% target? I mean, already you've got some questioning the commitment from France, Belgium, UK, Spain, whether these nations can truly contribute up to 5%.
Yeah, and it's at what cost? Because obviously this is going to come from somewhere, and there are going to be trade-offs here when it comes to spending from these countries. To my mind, what was most remarkable was President Trump and how the European allies treated him. I mean, it was an incredible display of, as you called it, diplomacy there, but many would say, buttering him up. It was a charm offensive from Mark Rutte.
But who are these genius critics out there who know diplomacy better than these leaders of I'm sorry. Yeah, agreed. There was definitely, as you say, buttering up of the US president. There was buttering up of the man who has responsibility for $1 trillion of defense spending, who has responsibility for either keeping Abrams tanks and Patriot missile systems and AWACS systems and what have you in Europe or not as well. I mean, for want of a better word, what do you think we should do? We should just say, no, Mr. Trump, we should be really tough on you. And then he pulls out his military hardware. It's like, it's a no-brainer. Show diplomacy. I know, but there's so many critics out there who are basically sniping about the way these leaders did it. I have criticised every one of these leaders 100 times on this channel about bad politics and bad economics. It's surely the right thing to do.
But on the trade front, that's a completely different approach. The Europeans have fired right back at President Trump. They didn't choose to go down the route that Keir Starmer did. They're talking now, but initially this was not their approach. This marks a very different tactic to what we've seen from Ursula von der Leyen, who's come back on the trade front saying, hold on, we're not going to give you what you want. We're not going to just butter you up and charm you. So it is a different approach.
I agree, but maybe if we had an interview with the German foreign minister where this question was asked as well about what it meant for the trade front, which we're going to show a little bit later on, maybe we could see a little bit more of the tactics there. Oh, yes, we have.
I love that they've coined the phrase already of the Telegraph, the daddy strategy that conquered Donald Trump.
Well, that's an allusion to what Rutte said.
Yes, exactly.
Which is a shame for Rutte that he was asked about leaked text. But, as quite rightly Rutte said, look, if you put something in a text or a WhatsApp or whatever it is, you kind of know that it's public domain.
He was pretty cool about it, wasn't he? Water off a duck's back.
It wasn't that different also to what he said in live on air with President Trump. The text pretty much matched the rhetoric that he used in person.
Consequences too, I think, for Iran yesterday, but we'll get to that later in the show. In the meantime, as we pivot towards these spending commitments, European leaders will meet in Brussels today with Ukraine, Israel's conduct in Gaza and defense high in the agenda. This as German Chancellor Friedrich Merz pushes for more urgency on a trade deal with the United States, calling for the current negotiation strategy, saying it's far too complicated. Let's get to Sylvia for more from Brussels. Sylvia, we're just talking about the big arm of diplomacy that was displayed yesterday in defence and whether there could be some momentum as we carry across to trade talks. But it is a full agenda today. Just pick up on where the NATO summit left off and talk about what leaders are going to be up to today.
So no doubt, Karen, that European leaders gathering here today will try to use that momentum from the NATO summit onto their actual conversations here. And I would highlight that there's a lot of topics on the table for the 27 heads of state gathering here later today. But I would highlight one of them in specific, and that is what they call the EU's place in the world. The reason why I'm highlighting that is because that topic will bring up the EU's relationship with the United States. And of course, off the back of that NATO summit, their relationship seems relatively warm for the time being. But of course, there are question marks here about whether where we're going to go next when it comes to trade negotiations. I spoke to one senior diplomat yesterday, and he told me that the Europeans do not like tariffs. Of course, we knew that already. But when it comes to conversations with the United States on trade, we are not there yet, the senior official said, in terms of having a deal on the table. But the deadline of July 9th is ticking up. And of course, Brussels is very, very keen to have a trade compromise with the United States. We heard at the NATO summit, the French President Emmanuel Macron making a clear link there as well between trade and defense, telling Donald Trump, listen, we are spending more on defense, but we have to come up with an agreement on trade as well. All I know from the conversations that I've had here on the ground yesterday is that the Europeans are hoping for an agreement, but of course it remains to be seen whether Donald Trump wants to say yes to that. Ultimately, officials here understand that even if there's a deal on the table, that ultimately it will have to be the President of the United States saying yes to it before there's any sort of compromise or green light in terms of these trade conversations. So let's see what the EU leaders will say when it comes to U.S. trade conversations later today. But as I said earlier, there's a lot of topics that the leaders will be debating. And one of them is also Ukraine. Of course, a lot of European countries have just committed to spend more on defense going forward. But how can they continue to support Ukraine? And here, the expectation is that they will have some more encouraging words for Ukraine. President Zelensky will be joining the meeting online. But of course, ultimately, for the time being, what the Europeans are likely to say today is that they are keen to see Ukraine joining the EU. They will make some positive remarks in that sense. But ultimately, we know that Hungary is still blocking official progress on that front. So let's see what's going to happen. Of course, they will also be talking about the tensions in the Middle East. So there's no doubt that there will be a very busy day for the 27 heads of state gathering here, guys.
Sylvia, thank you very much for setting the scene for us. Coming up on the show, Shell confirms it has no intention to make an offer for BP after renewed reports the company is in early talks with its UK rival. Plus, retail detail will dig into Swedish retailer H&M's latest report card as US sportswear giant Nike prepares to release results later today. And the UK's largest ever private credit deal goes nuclear. We'll speak through the monumental £4.5 billion debt financing package for Hinkley Point C nuclear power station with the European head of Apollo Global Management, Robert Seminara, at 9:30 BST.
Welcome back to the program. The expected boom in European infrastructure projects over the next 10 years has private markets looking to capitalize on the opportunities, with U.S. asset management giant Apollo set to enter into one of the UK's biggest deals in this space. This is a fascinating deal. Apollo has committed to provide £4.5 billion loan to French utility EDF, primarily to finance projects in the UK, most notably the Hinkley Point C nuclear power station. The unsecured lending will see see Apollo provide an investment-grade debt financing package at an interest rate below 7%, a source told CNBC. Now, this transaction represents one of the largest sterling-denominated note issuances on record, Apollo said. The nuclear project has faced controversy and rising costs, with tensions between China General Nuclear Power Corp and the UK government leading to CGN pulling funding in 2023, leaving majority owner EDF to pay for the project alone. Costs have surged toward £48 billion amid supply chain headwinds and labor shortages. Well, for more on that story and why the deal was attractive to the firm, we'll be speaking to Apollo Global Management's partner and head of Europe. Don't miss that conversation coming up at 9:30 BST. Now, as companies look to capitalize on these opportunities within European infrastructure, global investment firm Actis has raised $1.7 billion for its second long-life infrastructure fund with a focus on renewable energy and emerging markets. Torbjorn Caesar, chairman and senior partner at Actis, joins us now. Torbjorn, thank you so much for being with us. Let me kick off with a question about the environment coming out of the White House right now, coming out of Washington. There's been a real de-emphasis, a deprioritization of sustainability, renewable energy since Trump 2.0 came into the White House. Has this impacted investor sentiment in your experience toward investing in sustainable infrastructure projects?
Thank you. It's great to be here. If you're looking at where we invest, as I say, from the non-US and non-European markets, that's where we have 85% of the world population. I mean, you have 2/3 of the investment opportunities there. I mean, yet you only have 1/3 of the capital chasing it. And I think that opportunity there for, should we say, most of the world, the non-US and non-European markets, I mean, that growth that we had there has been a long trend of getting more opportunities there. And as you mentioned, our 1.7 billion long life infra fund, I mean, we've raised about 27 billion here over the last 20 years. So I think we see an increased interest, in infrastructure, critical infrastructure, electricity and digital across the world, most of the world, the non-US and non-European markets. And I would say that's rather, irrespective of what's happening in US and Europe.
Can you give us a little bit more color on this new fund that you've closed, $1.7 billion? Sounds like you're looking at emerging markets here. Where specifically are you looking to deploy?
Yeah, you're right. I mean, it's the emerging markets, or should we say, as I said, most of the world, the non-US and non-European markets. So it's in electricity, it is in digital, I mean, it is in transport across, Asia, Latin America, and all, other of the non-US and non-European markets. And say, last week I was in Manila, where we are building the world's largest solar and battery storage project. And it's a fantastic opportunity to provide clean and reliable and, the cheapest form of electricity to the population in Philippines, where that was, right? So it's across Asia, across Latin America, Middle East, Eastern Europe. So the non-US, non-European markets, I mean, I think it's just a fantastic opportunity we see there.
Torbjorn, from a humanity point of view, I get it. It's fantastic. But from a hard-nosed investor point of view, you know this as well. The fact of the matter is, according to the Association of Investment Companies, renewable energy infrastructure sector has delivered a 5% loss over the last 5 years compared with a 67% gain for the average investment trust. That is a huge disparity for those investors who want to get involved in energy renewable infrastructure, sir.
I mean, I would say clearly, we wouldn't have raised 27 billion if we are not, delivering outsized, fantastic risk-adjusted returns, right? And now coming back to this main point of perception of risk. So if you're thinking about supply and demand of capital and supply and demand of opportunities, if you're looking at then 2/3 of all the investment opportunities are outside US and Europe, and you only have 1/3 of the capital chasing it. 2/3 are busy chasing each other, in Europe and US. That's mismatch between supply and demand and capital. I mean, really creates fantastic investment opportunities, and we clearly deliver that.
There is an increasing complementary nature that we're seeing between energy infrastructure investing, sustainable versus and digital as well, because data centers are coming in a big way. How are you thinking about that opportunity and still ticking the sustainability box?
Yeah, no, absolutely. I mean, it is a huge and growing area. I mean, if you're looking at look at the markets we're focusing on, and tying them to talk about renewables, but an energy transition. In these markets, it's more about energy addition. I mean, you need to make sure you build new electricity to both the economic growth, which needs electricity, but also then, as you say, the increased need for power and green power, cheap renewable power there too, data centers. Could it be cloud? It could be AI. So it's just an additional growth that we see in the markets that we are focusing on.
I want to bring up something that you were discussing in a podcast recently. I thought it was fascinating. You were talking about not necessarily growth markets, but most markets. What does that mean?
Yeah.
Just unpick that for us.
Yeah, no, there's no real good term. Your colleague used to say emerging markets, and then you can look at, we invest a lot in Japan, we invest in Korea, if you're looking at Mexico and Brazil or India, and these markets, the growth there, and I would say the south-south trade you have, say if it's Indonesia trading with Mexico, or Brazil trading with India, or Dubai with Romania, which have that south-south trade has overtaken the north-south trade and is growing faster. So that the area to invest there, outside Europe and US, I think it's just fascinating and an amazing opportunity. And there's no real good word for it. That's why I call it most of the world, because 85% of the world population lives there.
You've made the point in two answers now, Torbjörn, as well. Tell us why investing in US. I get it. It's rocky politically. Why is investing in European renewable infrastructure such a bad scenario, given despite all the promises about deregulation, all the promises about more spending as well? What's so wrong with Europe?
No, I don't think it's wrong at all. I think it's an exciting opportunity. I think so is US. I'm just saying that what we are focusing on is the growing interest, outside US and Europe, because that's where you have 2/3 of the investment opportunities, repeating myself, and 1/3 of the capital chasing it. And the perception of risk is such that it's higher, but I would argue it's not, because electricity and critical infrastructure is in short supply, and being in short supply, that is the best risk mitigant you can have. People want your, product, your electricity, the infrastructure you have. So I think it is a great opportunity. It doesn't say it's bad in Europe and US. It just means that there is a fantastic opportunity that we are focusing on. And I think our investors are increasingly opening their eyes to it. And that's, all the capital coming in. And I'm looking forward to get more competitors and more people coming in, more capital to flow, because it is really a large opportunity here.